Well, good evening, everyone, and welcome to our Altos Trading Live Strategy Session with Jeff Tompkins. This is your host, Richard Van Rich, and we have Craig Ward with us every week as we do in the chat. Thanks for being here, Craig. I know he's a little under the weather tonight. I want to thank all you guys for being here as well. Got a great session to go over tonight. Got a lot of new folks on, and if you are new and joining us for the first time, you'll notice that your microphones are muted, and that's how we can all hear Jeff and I talk. But there is a Q&A box located at the bottom of your screen. If you move your cursor around a little bit, Q&A and chat. Put your questions in Q&A, and we'll see those throughout the evening and answer those periodically and also before we sign off. If you do somehow get bumped off or you got to leave, don't worry. This is recorded and will be available in the members area later tonight and sometime on YouTube tomorrow. And if you're watching us on YouTube, please like and subscribe our video so that we can get more of those posted out there and to you. Let's see here. If you have any questions about your account, access to Trade Transillion, trade alerts, anything like that, anything about your memberships, email support@altostrading.com. And our guys will get to those sometime tomorrow. So before Brand Jeff, let me just read the disclaimer real quick. Altos Trading LLC and Trade Transillion software is intended to be used as an information service for subscribers, and it includes opinions as to buying, selling, and holding various stocks and other securities. However, the publishers of Altos Trading, Trade Transillion softwares are not brokers or investment advisors, do not provide investment advice or recommendations directed to any particular subscriber or in view of the particular circumstances of any particular person. Altos Trading LLC, including its owners, do not accept responsibility for any decisions made by subscribers using the software, and subscribers to the Trade Trans/Zillion software or any other persons who buy, sell, or hold securities should do so with caution and consult with a broker or investment advisor before doing so. All right, with that being said, let me bring on Jeff. Jeff, you there?
Greetings, everybody.
Hey. How you doing?
Good. It seems like we just did one of these.
I know,
that's because I guess we did last week. We did Thursday, right?
Yeah, but it still felt like a week ago. I feel like Thursday was a long time ago.
Yeah, I guess it kind of does.
Yeah, it does to me.
Well, it's good to be back. Good to see everybody back again. Thanks, Richard, for the introduction. Greetings and salutations. That's my line, Ari. I use that all the time.
That's right.
Greetings and salutations. Great to have you guys. So what a day today. What a couple weeks in the market we've had. It's again largely driven by inflation, right? So we got another positive inflationary report. Seems to be slowing down. I believe it's wholesale inflation this morning. So that's a good sign, and it's the catalyst behind the positive moves we're seeing in the market. And we'll cover our market overview and what to look out for in terms of levels for the rest of this week. And then we'll review the 36-month moving average being halfway through the month of November. We've got a couple of weeks left, and we're, of course, coming into holiday week with Thanksgiving for a potential close above the 36-month moving average on the S&P, which would be very positive for the bulls out there. So we'll cover that. And our strategy topic for tonight is option ratio spreads. And we've talked a little bit about the ratio back spread in past live sessions. This week, we're going to look at a specific system and strategy for the option ratio spread. And so we'll cover the mechanics of the strategy, the tools and indicators we'll be using, when it makes sense to use the strategy, and then get into a bit on how to manage the strategy as well. And then if we have time, we'll open it up to ticker roundtable and then wrap up with Q&A. So a lot of great stuff to cover tonight. And I'll go ahead and get over to our dashboard so we can take a look at the markets. Let me just make sure we've got refresh it and get today's current data. And we'll pull up the S&P. All right. So had a gap open this morning, closed lower on the open, but still closed much higher from the previous close yesterday. So again, things are looking pretty bullish. We broke through a key resistance level that we talked about on last week's session on the S&P are right around 3,900. And told you that if we, last week, if we break through that, to look for a move up into the 4,000 level, which we have now encountered, and closed just a tad below, just a little under 9 handles below that significant millennial market 4,000. So starting to see a little bit of stalling here, but good news is, although if you look at the lows today on the S&P, which were down around the half-century mark of 39.50, we got buyers coming in at that half-century point and propelling prices back up. But we did close below that 4,000 level. So we're going to want to really watch 4,000 this week. Zoom out a little bit here. As a resistance level. And it's the nearest resistance level that we're encountering. So there's resistance, and what we're looking for is the S&P to close above 4,000 for an indication of higher potential for continuation of the uptrend. So if 4,000 continues to hold as resistance, we may see a retest of 3,900, which was our prior major resistance level and has now become support. So for this week, those are the two most significant levels to keep an eye on. Now, if 3,900 breaks, that's going to be very bearish for the markets. So I suspect, based on the recent data that's come out regarding inflation, that 3,900 will hold. But if some unforeseen catalyst comes along, or there's enough profit taking on long positions that we have a close below 3,900, that's really going to shift the current sentiment from bullish to bearish. And, we'd almost very likely see a move into the 3,800 level, and potentially even the 3,700 to 3,650. So if that 3,900 level breaks, we've got multiple layers of lower support that we're likely to sell off into. So I circled that 3,900 level because it is key now for the market to stay above that level to continue to see the rebound that really began back in mid-October, which was lows from the year. So my sentiment right now is bullish. Remember, as we talked about last week, the markets tend to lead economic slowdowns and recoveries. So as we're seeing now, the catalyst driving prices up in the major indices being a slowdown of inflation and a potential reversal, is still in the midst of a high risk of recession and some other macroeconomic factors that are bearish for the markets. But as I mentioned last week, we'll likely see the markets rebound before inflation returns back to normal levels. So that could already be occurring if, in fact, we have peaked at inflation. And we probably won't know the true answer to that until we get a couple more CPI reports. And one data point doesn't make a trend. So we need to continue to see inflation get reined in. And I think with the Fed rate hikes that have taken place, it likely has. So lots of lower support with our real key resistance at 4,000. And if we can break and close above 4,000, we've really got a lot of upside potential. And so we may not see this by the end of this week or even the end of November, but we could really rip higher if we can close above 4,000. And if that can hold as, transition from a resistance level to a support level. So a lot of potential there. And as we'll look at momentarily on the 36 month chart, or the monthly chart, or the 36 period moving average, that's currently looking bullish on the S&P, with about half. We're through half of the month, so we got a little ways to go, but that's looking good. So we'll look at that in just a sec. But first, let's look at the NASDAQ 100 ETF, the Qs. And like the S&P, looking bullish, we've broken through a major resistance level that we also talked about last week. And I mentioned that if we break through this 285 level, look for a rotation higher, and potentially a retest of 285. In fact, I pretty much drew this before it happened last week. Breakout, retest. We didn't quite come down today and retest, but got pretty close. So if we can see 285 hold, then I think we're looking at a move higher, continuation of this move. You can see how strong this level is. Prior resistance, now currently support. Okay, and last week we also looked at the buy signals on the index products. All right, so we got a triggered buy, and that's looking very nice as well from trade trend. So this, in terms of a little bit different than the S&P, we've really broken through a more significant resistance level on the NASDAQ than we have on the S&P, because again, we're looking at 4,000 on the S&P. Kind of made it through the significant resistance on the NASDAQ, which could have bullish implications for the S&P as well. So as long as we see this 285 level hold on the Qs, we did kind of encounter this 295 resistance. Not quite, but that's one to watch on the Qs. And if we can get through that, we've got really major resistance at 310. So if we can get through 295 and even 300, watch for stalling of price or reversal around 310. Okay, so there again, looking bullish. Now, if we break back down below 285, we're going to want to watch the 270 level and the 260 level for support. Yeah, but all signs right now are pointing to this 285 level holding and a continuation of the move higher. And then if we look at the VIX, the volatility index, we got a pretty big intraday spike in the VIX, which was interesting considering we got a big gap up. So one thing to take note of here is we are seeing volatility expand and pick up on the VIX. So we want to be a little bit, cautious in the context of the volatility spike on the VIX. Because although we saw a close higher today on the S&P from previous day's close, we're seeing a bit of a divergence here. Normally we would see a drop in the VIX, but we saw it spike. So it's just something to be a little cautious of in the context of the recent up move. 22 to 23 is our support zone on the VIX for this week. All right, so if this support zone holds and that resistance level at 4,000 on the S&P holds, and we see a rotation lower in a subsequent on the S&P and a subsequent spike higher on the VIX, then I expect we'll see a near-term retracement to the downside. But in terms of price action, the good news is although we saw a big spike in the VIX, it was up into a resistance level at 26 and a intraday move lower. So we'll watch the 26 level for resistance through the rest of this week. And ideally, what we really want to see before the end of the year is VIX come back down into the 20 level or below. We've just been so elevated this entire year on the VIX. And it stayed relatively high. Because remember, like all-time average on the VIX is below 20. And the historical low on the settlement price of the VIX, so it's not what you're going to see on the chart, but the actual AM settlement price, which settles Wednesday mornings, is below 10. It's like 9 and some change. So, from historic low, we're very elevated. From average, we're still fairly elevated on the VIX. So going into 2023, if we want to really get confirmation of an into the bear market, we want to see VIX start to stay below 20 for more than just a week and not dipping below and then closing back up like we saw in early to mid-August. All right, so those are the things to watch in terms of levels on NASDAQ, S&P, and VIX. And let's take a look at the monthly chart. Oops. On the S&P. All right, so it's looking as though we have a good chance, and you'll notice there on this monthly chart, our open is almost right at 3,900, 3901.79 for the month. So we opened November on the S&P at 3901.79. And remember how I mentioned that's such a significant level on the S&P to keep an eye on. It's also right around the high of October, the month of October. So if we look at the current level of the 36 period moving average on the monthly chart, it's at 38.43. Okay, so again, we want to see a close above this 36-month moving average in November to give us real solid indication that that we'll see a continuation of this uptrend that started in October. And I think we have a good chance of it. I think this big move lower that we've encountered in 2022 will likely, be mostly over. We could see continued rotation around these levels versus like a quick snap back to the upside. But as far as the magnitude of the peak to trough sell-off, this could be the end of it if we can just stay above the 3,900 level on the S&P and the 36-month moving average. So it looks like, it's looking more like we put in our market lows for this bear market. But again, we'll still to be determined. We'll see what happens here this month. And then we look at the NASDAQ. We're still working our way back up. All right, so we're, we've had a very strong rotation higher off the 11,000 millennial mark, which is good. So same case, we could have put in the lows peak to trough on the NASDAQ, but here we've got more room to the upside before we can get a close above the 36-month moving average. Is it out of the realm of possibilities for November? No, but it's really going to take a lot more buyers to come in. And it's possible. We broke it through that major resistance level that we looked at on the Qs, so it's possible. All right, so go ahead and pause there and see if there are any questions on the key index levels or market overview.
One came to me. Being next week is, the holiday Thanksgiving. Do you typically avoid trading that week?
We actually tend to see historically some bullish moves around the Thanksgiving holiday. I'll hold open positions into Thanksgiving, but I do lighten up around holidays in terms of trading volume and frequency of trades and things. And just know that that's not just me. That's the volume tends to thin out during major holidays like Thanksgiving and Christmas. So you might still see volatility, but it might be driven by thinner volume. So just something to keep in the back of your mind. But I think during periods of thinner trading volume, it's generally, rule of thumb, better to sit on the sidelines and wait for markets to return back to normal trading volume.
That's all I got.
All right. Well, let's go ahead and get into our topic for tonight, which is option ratio spreads. And again, we've covered the ratio back spreads in previous weekly sessions, but I'll give a bit of a recap on what they are, and they can be used for both bullish and bearish positions. So let's just use the S&P 500, the SPX. And we'll take a look at an option chain and basically what they consist of, how we structure them. But a ratio spread is basically where we're going to sell, both sell and buy within the same expiration. So we can just choose an expiration. Let's just go 30 days out. So that would be December 15th expiration. And we're going to sell and buy at a ratio of 2 to 1. And if we're going to do this like with a ratio call spread, we'll start with calls as an example. We're expecting the price of the underlying to move up. And for these to really be successful, we need a significant move to the upside. Okay, and then generally beyond the expected move. Right, and there's our expected move between now and December 15th of 228.53 points up or down. Right, so to construct the ratio spread, we want to sell at a strike that's close to at the money. So like today, the SPX closed at 39.91.73. All right, so we want to kind of sell at a strike right around the current price. And generally that's going to be, it depends on the product too. Actually, another rule of thumb is just to use the delta. But we want to sell kind of between a 45 and 50 delta. So actually a 50 delta is a little bit out of the money. Remember, we've identified 4,000 as a major resistance point. So I might actually want to sell a strike higher than 4,000, because if we push above that, I've got the potential to make some good money if we can get, because if we break 4,000, then like we looked at in our market overview, we've got a lot of room to run to the upside. So this might make sense. We're going to look at some rules for using the Bollinger Bands to set up the strategy as well. But we can use our key levels, our support and resistance, and then we'll look at using standard deviation moves, Bollinger Bands. But so our delta, we about 45 to 50. Now, normally the 50 delta is going to be closer to at the money. Currently, the 50 delta on the SPX on the call side is at 40.10 at our 40.10 strike. Right, so there's our 50 delta. Okay, the 40.10 strike. So again, we want to use the 2 to 1 ratio. So if we were to sell one 40.10 strike call, we would then buy, Okay, so then we're selling short. And basically we're selling short to finance the cost of buying the out of the money calls. And how do I know if I'd want to use this strategy would make sense in current market conditions? Well, I look at implied volatility. So we've talked about volatility skew in past sessions. And the rule of thumb is we want to sell high implied volatility and buy low implied volatility. Implied volatility is a major component of the pricing of options. And the higher the IV or implied volatility, typically the higher the option price. So just like most markets, we want to buy low and sell high. So if IV at the 40-10 strike is at 21.79, I want to look for volatility skew. Is IV dropping as I go further out of the money or rising? Well, we see that it's actually starting to drop as I move further out of the money. Eventually, when you get far enough out, it starts to go back up. So we've got volatility skew. So if I'm selling the 40-10 strike call, as we would do in a ratio spread, and buying a further out of the money strike or a higher strike price, then I'm using options pricing to my advantage. I'm selling the high IV and buying the low IV. All right, so how do we, this takes a little bit of kind of trial and error to figure out our strikes. But rule of thumb, we want to buy kind of between a 25 and 35 delta. But since we're doing a 2-to-1 ratio, right? So we're selling, we're buying buying 2 contracts for every one that we're selling, right? So we're selling and then buying at a 2-to-1 ratio. So we want to look at our price at the strike that we're selling, right? In 40-10. Okay, so we're bid at 95.70, asked at 96.90. Okay, so right around 96, a little bit lower is our midpoint. We want to do this for I like to do them for just a slight credit, right? So we'd receive a credit. Now that doesn't mean the trade's risk-free. It just means that we would receive a small deposit into our account for executing the trade. So to do that, the 2 contracts that I buy for every 1 contract I sell should be roughly half or slightly lower than half of the price that we're selling, the strike we're selling, right? So we pull out our trusty calculator. Let's just say we can sell these. Oops, sorry, wrong. Just say we can sell these 40-10 strike calls at 96. I want to look at buying a strike that's priced just a little below 48. All right. So to do that, I'd have to go down to up to the 41.20 or 41.25 strike calls, right? And those have a delta of 32, right? So I want to stay between a 25 and 35 delta. So that works, right? So 41.25. Delta of 32. And those are bid at 46.40, asked at 47.40. All right. So let's see what happens if we set up a simulated trade, selling the 40-10s and buying the 41.25. Here's where we're going to use our risk graph. Okay. So we are going to go to the SPX. And we're going to add a simulated trade. And I usually like to go out about 30 days in expiration for these ratio spreads. Right. So if we we're going to do a call ratio. Selling the 40/10s. We'll just do this. Again, it's a 2-to-1 ratio, so you can scale the contracts based on your account size and risk tolerance, but we'll just do 1 to 2 to keep it simple. All right, and we're going to change our long strike to 41.25. Okay, and you'll see that we can do this trade for, oh, why didn't that work? A credit of 250 for the spread. All right. So again, you want this just to be you don't want to do these for a big credit. Don't try to do these trades for a big credit. They're not going to work out well. You want to do them for a very small credit. Now, if we look at our risk graph, this is about what you want the risk graph to look like, right? So let's analyze this. This hypothetical trade example expires a month from now, December 15th. We're selling at buying at a 2-to-1 ratio, selling the 40/10 strike calls, buying the 41.25s. Now, if the now see how I've structured this based on the deltas, the option pricing to get just obtain a small credit, and then resistance at 4,000. So we want the S&P to break through 4,000. If it breaks through and rips higher, this trade has a lot of profit potential, right? So you'll see, and we can step up the, this is for today, we can step up the expirations. Let's just say tomorrow, let's see, today's the 15th, so end of week is at, the 18th is Friday. So let's just say by Friday, the S&P tears through 4,000 and goes up to 4,200. This trade on Friday would be worth a little over $6,000 on a move up. That's the purple line I've set to Friday's date. So that's pretty good. It has unlimited profit potential to the upside. If we went on a major tear to the upside, look where this thing can go. Now, what happens if we're wrong and the S&P goes down? Well, we collect a small credit. So if by expiration, the S&P is trading below 4,000, we would keep the small $250 credit. We'd have to hold the trade through expiration for that to occur. And the S&P would have to be trading below our break even, which is actually, let's see here, right about 4,013. Okay, and then we keep the credit, right? So what's going on here? This is what we call the valley of death. This is a worst case scenario for the spread. So if we held this spread through expiration on December 15th, and the S&P closed at roughly 41.21 to 41.22, we would experience a max loss, max potential loss, which is almost $11,000 on a 1 to 2 ratio contract. Selling one contract, buying two. We don't want that to happen, right? So there's a way to avoid this. And that is we don't hold the trade up until expiration. So that's key. Unless the S&P really crashes and it's trading way below our break even, in which case we could hang on to it to expiration. We don't want to hold the spread till expiration because we risk closing in the valley of death, which is the blue line here, and where we could experience a significant loss in the spread. And you'll notice this is where the time component and being able to analyze different periods of time in the cycle of an options trade is so important. Because if I look at the valley of death here on expiration day, a month from now, it's very ugly. But if we hit that price this Friday, it's beautiful. It's almost a $3,000 profit. This is because of the time component of options. So you can be at the exact same price one day and make money, and another day lose it. And that's, for an options ratio spread, going to be at expiration. Right? So we don't want to hold this trade till expiration and risk the valley of death. So
That's like a trench.
yeah, exactly. It's like digging yourself a grave, right? Maybe I'll just call it a grave. 6 feet under.
That's right. Hey, Linda asked if you could show it 2 weeks out just to kind of see the impact.
Yeah. Let's clear this. So that would be the 29th, 2 weeks from today. So you'll see we need a bigger move to the upside. So why is that? Well, there's less time for the move. There's more time for the move to occur between now and the 29th. So this may become irrelevant because we could close the trade before the 29th. But if by the 29th, the S&P hasn't moved a penny, this is going to be what we're looking at. We need a bigger move to get into profitability. So that break-even point on the 29th is at 41.10. So if we're at 41.10 on the 29th, we're basically at break-even. We haven't made or lost anything. Our credit point of credit, where if the S&P is trading below that price at expiration, doesn't change. So as long as we're below, right around a little over 4,000, 4,010 at expiration, we still retain the $250 credit. Right. So that's why it's really important to use these risk graphs as you put on options trades, regardless of the strategy. And you can do different, step expiration. So you can look at more than one expiration at a time by using step expirations. We won't get into that tonight because it will eat up a lot of time. But yeah, to put it simply, you can, like we just did for Linda, is you can just change the expiration date to look at potential outcomes based on future dates in time. All right, so that's basically how you set up a ratio spread. So if we were going to scale it, for our account size and risk tolerance, you just want to keep it at a 2-to-1 ratio. So you want to buy 2 contracts for every 1 that you sell. The way that you'll know you're setting this trade up correctly is, number one, your risk graph should look about like this. The numbers will be different. We're just using the SPX as example. You can trade ratio spreads on any optionable security. But the things, again, to look for, we want to sell higher IV and buy lower IV. Our risk graph should look about like this. So you're going to see the valley of death, and you're going to see if we're wrong on a call ratio spread, this would be opposite for a put ratio spread. If we're wrong and it goes way down, we should be showing a small credit if we've set it up correctly by expiration. If it takes off in the direction that we've set the spread up for a call ratio spread, that would be the upside. Put ratio spread would be to the downside. We should see a nice steady move up in the near dated expiration that we're looking at, or not expiration, a date. But remember, we don't want to hold these until expiration unless we're completely wrong and the underlying just tanks on a ratio call spread. So if the S&P just tanks, it breaks through that 3,900 level that I said was such key support, and we just tank lower, then we can just keep an eye on it. I don't want to walk away and assume everything's okay, but we can potentially hold this through to expiration, keep the small credit. But if there's any chance of closing in the valley of death, we want to close this out. If we're going 30 days out in expiration, probably around a week before expiration. So we don't want to hold this much into the last week of expiration. The risk is too great if we can encounter the grave site here. So that's what the risk graph looks like. So let's look at, we're going to look at a chart now of the S&P and where I like to set these up. And that's using standard deviation moves. So remember what I said, we want to see, for these to really be successful, we want to see a move past, the expected move for that expiration cycle, number one, but also we want to see a fairly significant move. So let's go over to chart of the SPX. And actually, we're going to add on the Bollinger Bands. Okay. And actually, there was a setup for this last week. So the outer bands, if we use the default settings here, which is a 20-period SMA in the center and 2 standard deviations for the upper and lower band, we know that when price is at either the upper or the lower band, we're at a currently at a 2 standard deviation move from the mean or the average. All right, so one of 2 things usually happens at a 2 standard deviation move from the average. We either, there's, again, many different possible outcomes, but generally speaking, we're either going to rip higher. Right here, we hit the 2 back in mid-July. We're going to rip lower where we hit the lower standard deviation. So in this case, we would use a put ratio call spread. So if we're at the upper band, like we hit last week, I want to set up a call ratio spread. If we hit the lower band, I want to look at setting up a put ratio spread, because then our expectation, it moves down. Now, the reason I'm using the outer standard deviation band, where we're 2 standard deviations from the average, is, again, we want to see a move outside of the expected move. And if that doesn't occur, generally at these outer bands, we see price either rip up on a test of the upper band or down on the test of the lower band, or we see it reject the band and just move back, in which case we're wrong, right, about the trade. But you can see, often when we encounter these lower bands, we get strong moves. And all of these would have moves would allow us to close that ratio spread for probably a significant profit. But if we're just outright wrong and we bounce off a band and go back to the other band, then those are scenarios where we could potentially just exit for a small loss, or retain that credit that we kept, depending on how far the underline's trading from the valley of death, which is what we want to avoid. And that's why we don't want to hold the trade through expiration. The idea is for these moves to occur, and that's also the rationale behind using the outer bands. We're more likely to see if we get, and this is all part of our slingshot setup, if we get that move that trails one of the outer bands, it tends to happen rather quickly. So we're using it as a timing component. If we test one of the outer bands, generally very quickly, we're going to just rip in that direction or reverse, right? So that's also part of the rationale for using the outer bands. We're also at a 2 standard deviation move from the mean. So we're nearing the outer expected move. And if it follows that continuation of that move, we're going to be outside the expected move, and that's going to put our ratio spread into profitability. If it reverses and we're wrong, then maybe we can, salvage that and retain the small credit for putting on the trade. Again, so there's still risk in the trade, but if we manage it correctly, if we put it on correctly and we manage it correctly, it should be a scenario where we have the potential for large profits on some of these big sustained moves. And if we're wrong, we should have a small loss or retain a small credit. So that could get screwed up if you don't manage it correctly. If you hold this ratio spread up until expiration and you encounter the valley of death, you're going to have a big loss if you end up closing in that valley of death. So that's what you want to avoid. And so our intention is not to do that. All right, so management is crucial. So that's how I use the standard deviation bands. So it creates a way for us to screen for opportunities, right? We can look for optionable securities that are trading at one of the outer bands. Okay. And then I can start through the rest of the process, looking at my expirations. And I want to go, you can do these with shorter dated expirations, but I only do that if there's a very expected catalyst. So CPI would be a good example. So if we know we have a CPI report coming out and it has the potential to move the market big, I might do a ratio spread just for that week that expires that week, because I know there's a potential big move coming in the midst of high inflation. And then if I'm wrong, let's say I anticipate a move up, and we got that obviously on October CPI report, then I have the potential to make some good profits. But if I'm wrong and the market tanks and CPI comes in hot again and above analyst estimates, the market's likely going to sell off big, in which case I'm probably safe from the valley of death, and I might be able to just retain a small credit. So even though might have been drastically wrong on a binary event, I can still retain a small credit. So it's a pretty cool trade in that sense. As long as you manage it correctly, you can be utterly wrong and still make a small profit, or you can be right and potentially make a big profit. But you can be wrong and keep a small credit or sustain a small loss, right? So it's good to have a time horizon. You don't want to just put these on blindly. So using the Bollinger Bands is one method for the initial part of the selection of the underlying security. But you want to tie it in with our other methodologies. Support and resistance. Make sure if you're doing a ratio call spread, you're not taking it into a resistance level, or a put ratio spread into a support level. You want to have an expectation. So if you're going to put on a call ratio spread, you want to expect the underlying is going to make a big move up. That's the idea behind the spread. So those are things to consider. And then if you're wrong, be prepared to manage it correctly. All right, so those are the rules and how I use the Bollinger Bands. And I want to go, so I started saying, typically I want to go a minimum of 38 days out to set these up, unless there's a known binary event or catalyst on the horizon. That could be an earnings, so you could trade these around earnings for a company. And in fact, earnings once you get experience with them, that's a great way to trade earnings. A lot of people will just, buy a call or a put, and they get killed because of volatility crash and or they're wrong. Earnings are a binary event, and they're largely unpredictable. But ratio spreads are great for earnings releases because you can be utterly wrong and keep a small credit, or you could be right because we know that there's likely going to be a big move to the up or the downside. We just don't know which direction. So we can be right or wrong and still make money. We don't have to necessarily be put so much pressure on ourselves to guess the right direction. So earnings would be an example of a binary catalyst where you can use a ratio spread. So if you set up a call ratio spread on a company when you know they have earnings coming out, like let's say in a couple days, you could set it up short dated with Friday's expiration if the security has weekly options available on them. So that would be an example. If there's no known binary catalyst on the near-term horizon, then I don't want to set up a short-dated ratio spread because I don't know. I want to give it time for that move to occur, right? So minimum of 30 days in the absence of a known binary catalyst. You could go up to 60 or even 90 days on these. So you could do long-term if you really want to give it time to work out. Just remember, don't hold it through expiration unless you're drastically wrong and the valley of death is not a concern. So those are the rules. Let's address, probably had some questions come in. Let's take a minute or two to address any questions, Richard.
Yeah, Eric asked, why not do both at the same time when you don't know if the market's going to go up or down?
So you mean setting up a call and a put ratio spread?
Must be. Yeah, that's pretty much all he's written. Yes, he said yes.
Okay, so one thing you can do is leg into ratio spreads in opposite directions. The reason being is if you're going to do that, you are going to increase your risk exposure. So that's something to be aware of. You're going to have two valleys of death to contend with, which is going to lower the probability of success of the position because you're going to have both of those zones where you don't want the security to trade in. And you're increasing your risk exposure. So just be aware of that. But yes, you could set them up with, the awareness of the risk tolerance that you're taking, the two valleys of death. You're going to need, you're going to really want to be certain of a strong move, directional move to the upside or downside. So just some extra considerations there. And I would just suggest, be comfortable with choosing a direction and playing it that way until you really have the strategy down and start trying to get fancy with it, The other reason, though, and thing to look out for is the volatility skew. So again, you don't want to just trade these blindly. If you're doing your homework, you should really be looking at the volatility skew and the implied volatility. So like on the SPX, we looked at that. You want to sell high, buy low. So why wouldn't I set at this expiration 30 days out? Why wouldn't I just want to do a call ratio spread and a put ratio spread? Well, I saw that volatility skew is in my favor on the call ratio spread. What happens if I look at implied volatility on the put side? The skew is not with us. Remember, we want to sell high IV and buy low IV. If we sell an at the money or 47 delta strike put, our IV is at 2408, 24%. And then if we go out, we'd have to go even further out than I have on my screen here. Right, so our 47 delta IV is 24.08%. Options offered at 103. So, if I bought like the 38, 35 strike that are offered at 51, IVs at 26. So there's skew that's not in the favor of a ratio spread. So I wouldn't want to set up a put ratio spread on the S&P with a December 13th expiration because the skew's against me. I'd be selling low and buying high. That's the opposite of what we want to do. That can come back to bite you if you don't trade with the skew in your favor. So that's the other thing to consider. So you want to make sure skew's in your favor as well. And that often is not going to be the case if you're trying to trade both sides of a ratio spread, a put ratio and a call ratio spread at the same time. Not to say that you can't find opportunities for that, but most of the time you're not going to see the skew in your favor on both sides.
So like that.
Oh, okay. That was easy. I guess either everyone's lost or it made sense.
I think it's a two watcher.
Yeah. We'll have the recording up for you guys too, so you can rewatch. There's a lot to consider there. So M says taking lots of notes. Yes, need to see again. Yeah.
That's the thing about these options. I mean, you teach these different strategies that that's what's so great about. I mean, options is like it's almost like trading with like clay. Like you can structure these things to look any way you want them to, and there's so much flexibility and creativity in setting these things up. I mean,
Yeah, so true. And of course, that's a double-edged sword, right? That flexibility also provides the potential to get yourself in trouble if you don't understand, how to structure the trade correctly. Like, and what we just kind of covered, and that was a great question that was asked, because it led into the volatility skew. Is very few options traders pay attention to volatility skew, and it's one of the most overlooked causes of failure in options trading. So, professional options traders use volatility skew to help make their trading decisions. So it's really important. If you guys will be leaps and bounds ahead of 99% of all the retail options traders out there if you learn the volatility skew. And by the way, we've done past weekly sessions on that that you guys can go back and review on our YouTube channel. But just understanding that and structuring the appropriate option strategy around it will give you a really great edge. So that's really important. And then of course, managing it, right? So the other big mistake we see a lot of options traders make is the management of the trade. And, for instance, a trade like the ratio spread that we covered tonight, holding it through expiration, which you don't want to do. And most people wouldn't know, even know to consider that. They think, well, this expires December 15th, a month from now. So I've got 30 days for this to be successful. Well, actually, you have 30 days for this to be a potential disaster. You really have, maybe 3 weeks for this to be potentially successful. We don't want to hold it into that last week of expiration if we can help it, unless we're drastically wrong on the call ratio spread and the S&P tanks, then the valley of death may not be a concern and we can hold it and keep that credit, or maybe close it for a small loss. But that's the beauty of the ratio spread right there. So yeah, the management is crucial. And without looking at the risk graph like we did tonight on our session, we wouldn't know where that valley of death is. We wouldn't know by looking at the expiration date when we might encounter it. But the risk graph tells us all that. And that's, again, a very overlooked component of options trading. And we'll be using more risk graphs on our options strategy sessions moving forward as well.
Yeah, like I use that risk graph like just when I'm doing my iron condors, it's like mandatory. Like I use it. It's probably too much, like obsessively.
I don't think you can use it too much. And the nice thing is you can add, if you make adjustments to the trade, you can add those into your risk graph, and it's going to show you the impact it might have based on time till expiration and potential moves in the underlying security. So it really is a must use. I really don't think you can overuse it. I think it's probably, if anything, it's underused. And but yeah, I mean, you can see with the ratio spread, and it also, we all make mistakes setting these trades up, and I wanted to make sure to give you guys a couple of things to look out for. One, you don't want to do this trade for a giant credit. You could, do it for a small credit or even a small debit. And that's fine. And then, you've set it up correctly. But if you're setting this trade up and you're getting, a big credit, and your risk graph doesn't look like what we covered tonight, then, you did something wrong and you don't want to put the trade on. So it saves you from making a mistake. If you review the risk graph first, put it in as a simulated trade, look at the risk graph before you actually enter the order with your broker, and don't double check your work type of thing. So thanks, Eric. Appreciate that. Cool. All right. Well, since we ran up on the hour, we'll save more time next week for ticker roundtable. And want to thank everybody for joining this week. Also, and we'll have the recording up tomorrow, by tomorrow on the YouTube channel, for you guys to review. But please do keep an eye on those levels that we covered tonight. They're critical for this week and will likely come into play, if not by next week during our session. That did go fast, I know. Thanks, Charlene. I appreciate that. Thanks, Jose. Good to see you on, Jose. So I hope you guys have a great rest of the trading week. We are planning on being back next Tuesday, even though it's Thanksgiving week, I believe. But not to worry, we do record. If anything changes on that, we'll let you know. But we do plan on being back next Tuesday night at 7 Eastern. So I hope to see you guys all back then. Have a great rest of the week, great weekend, and we'll see you guys next Tuesday night.